Empirical evidence on semi-strong form of efficiency. Semi-strong form of efficiency based on the market information and publicly available information, how these information has an intensity to determine the market price. For the purpose, the event study is deployed by the researcher in order to understand the efficiency of market. So the market reaction for the specific information is being analyzed. The information may be related to the financial information, or maybe the market related information, or even economic related information, industry specific information. So different form of information is being taken, how these information reached to the market, and what is the reaction of investor towards that particular information, and to the overall market and to the specific stock, what is the reaction is going to be measured under event study. So I'll take the procedure for conducting the event study. The event study is conducted. At first, the researcher needs to identify the event, and the event to be studied before and after the performance in the market. The returns are going to be collected for the specific security before the specific date and after the specific date. So what type of information? The information related to the financial information, non-financial information, maybe a market related information, information related to the industry, information related to the economy, the kind of information have been taken for the study. If you take for example the finance related information related to the dividend declaration, stock split, maybe the kind of IPO issued by the company in the market, what is a reaction which was happened in the secondary market going to be measured. So like the acquisition, merger related events, like can be taken for the financial related information, market related information based on the performance, expansion, diversification, joint venture, and like the information pertaining to that industry as a whole, the kind of taxation for the specific industry, tax policies related to that specific industry, like the industry related factors, the competition prevailing in the market, and like the economic specific information related to the crisis which was happened in the economy over the period of time, maybe a kind of the trend what is prevailing in the economy, maybe increased amount of foreign institutional investment into the economy, the inflow or outflow of the foreign investment into India. So different parameter is being taken for understanding the movement of market, the purpose in which the event study is used. The first step in event study to identify the event. Let's say for example, if I'm going to identify the event, that the company has declared their annual profit. Maybe that information has reached to the market on 2nd May 2022. So this information reached to the market. So 2nd May 2022, the company has declared their profit. Maybe the profit of 70% it is increased compared to the So in this, the 2nd of May 2022, the company has declared their profit of 70%. It is higher compared to the previous financial year. So this information has reached to the market. So the event study may be conducted for this specific event, the declaration of annual profit by the company. So the researcher is going to collect before and after the data is going to be collected for computing the rate of return. What is the rate in which that particular prices are traded before the event which was announced by the particular company. After the event has reached to the market, what is the reaction in the market? How the investors are perceiving the information what have been received from the market. So this is going to be identified. So the first step is going to identify the event and how the data is going to be collected, how the returns are going to be collected. That we call it as an event window. So the event window, what are the dates which consist in the event window where the returns are going to be collected? So let's say for example in this, it is 2nd May 2022 is a event date. I'm going to collect 10 days, 10 working days prior to that, 10 working days after that particular period. I'm going to collect the data related to the market. Let's say the stock prices during the last 10 days, past 10 days, and the next 10 days for the specific stock. So that the date which was followed from the 21st of April to 12th of May, for example. So 25th of April to 12th of May is called it as an event window with the event date of 2nd May 2022. Before 10 days and after 10 days. It means 10 working days taken for the study for computing the returns. So the first step, you need to identify the event and determine the event window, how much the duration in which the data is going to be collected. So once the data is collected, the data, it means the price related information have been collected from the market for the specific period of time. After that, collect the returns in the data around the announcement date. What is that? The announcement date is 2nd May 2022. For that, the data is going to be collected from 21st April 2022 to 12th May 2022. The returns are going to be collected from the market. What is the rate of return generated by the stock for each trading day is going to be calculated, and those returns are going to be recorded for the purpose of conducting the event study. The third step is going to calculate the excess return around the event date for each firms in the sample. For this specific purpose, there is a model is being used by the researcher. It is Iapm, the capital asset pricing model, which is used to discover the superior return realized during the specific period of time. Can say it is expected rate of return during the specific period of time. What is a market? What is a market condition? What is a risk is prevailing during the specific period of time? And that particular risk, for compensating on that particular risk, what is a return is expected by the investor, is going to be identified by using a model called Iapm, capital asset pricing model, where the capital asset pricing model is used by the researcher for calculating expected rate of return. Here E or J is represented as expected rate of return. This expected rate of return is calculated from the RF plus beta of RM minus RF. It means what is RF here is a risk-free rate. During the specific period of time, what is a zero beta, or what is a return is going to be generated by the investor without taking any risk. That is going to be calculated. How it is going to be calculated? The zero beta is going to be calculated. For that, we may use the rate in which those period, what is the rate in which the treasury bills are traded in the market, or the government securities are available in the market during the specific period of time. So those rate is being taken as a rate in which, without taking any risk, this is what the return is generated from the market. Let's say for example, during the specific period, it means 21st April 2022 to 12th May 2022, there is about the 5% in which the treasury bills are available in the market. You know, normally the treasury bills are issued in the market at the discount rate and will redeemed at the par rate. During the period, it is calculated, the explicit rate is defined, or it is calculated from the implicit one. It is about 5%. So the 5% is a risk-free rate of return generated during the specific period of time. And what is the risk is associated with the market is going to be estimated by using beta, systematic risk. So with that particular period of time, what is a movement of index or the points respect to the specific market and related to the stock which was listed in that particular market. What is the value of beta? The value of beta is calculated. So you know how to calculate the value of beta. Beta value is calculated covariance of return generated by the stock and the return generated by the market. It is calculated divided by the variance of market return is calculated, where you can able to understand what is the value of beta. You need to interpret the value of beta. Beta is equal to 1. It is assumed that the risk generated or risk associated with the market is equal to the risk associated with the specific security. If the value of beta is less than 1, the market risk is high compared to the stock risk. Those stocks we classify as defensive stock in nature. In case the beta value is more than 1, assumes that the market risk is less than the stock risk. The stock is aggressive in the market, the rate of return or the risk associated with the stock is high. So with this, you need to calculate the beta, value of beta. Assume that the value of beta is 1.5. Assume that the portfolio is aggressive in nature. Assumes that the investment into the specific stock or the return generated by the specific stock during the period is high volatile in the market. So it is 1.5. Let's take what is the rate of return generated. It means average rate of return generated by the market. Assumes that the average rate of return generated by the market is 15%. So the 15% is a rate of return generated by the market. 5% is an average rate of risk-free instruments in the market. 1.5 is the value of beta in the market. So with this you can calculate what is expected rate of return. It is 5 plus 1.5 multiplied 15 minus 5. So 5 plus 1.5 of 10, it is 15. 15 plus 5, 20. It means the 20% is a rate of return expected by the investor to invest into this particular market. The way in which you need to calculate the expected rate of return from the investor. So that is calculated using Iapm. The inputs which required for Iapm is calculating the risk-free rate, risk premium, risk-adjusted return is going to be calculated. Based on that, it is estimated the expected rate of return. Once you estimated the expected rate of return during the event window, for this event window, it is 20%. It is estimated. So with that, you need to calculate the abnormal return around the announcement date for the each firms in the sample. What is each firms in the sample? It is represented as M. It is each firms in the sample number of firms which was included in the market. Let's say, for example, if I'm going to take the stocks related to the specific stock, like for example, the annual return or the annual profit declared by the banking stock. Say for example, the State Bank of India has declared the annual profit, which is 70% higher compared to the previous year. So with this, a banking industry, the bank index is taken. Assume that in that bank index, there are about 12 stocks are listed. 12 companies are included on that particular index. So that 12 company, we call it as the number of companies, number of firms in the event study. So it is taken. It is calculating the abnormal return announced the event date, announcement date for each firms in the sample. So it is not only calculated for State Bank of India, it is also going to calculate it for the rate of return generated by the each firm in the event study. It is going to be calculated, we call it as abnormal return. It is actual return minus excess return, or we call it as what is the average rate of return generated by the stocks in the event study minus expected rate of return. It is calculating the abnormal return generated by the firms. The next one, you can compute the average abnormal return during the specific period along with the standard error can be estimated from the firms in the all sectors. It is average abnormal return can be calculated. It is calculated what is the abnormal rate of return generated during the specific period of time. divided by M, it means number of firms in the event study. Let's say, for example, in that the portfolio, in that the market index, bank index, there are about 12 firms are there, 12 companies are included on that particular index, where it is going to be calculated, expected rate of return is going to be calculated for the firms in the event study. For all firms it is going to be calculated, and it is going to be specified what is the rate of return generated by the specific stock during the period of time. So actual return minus expected return is calculated as abnormal return for each firms in the event study. Once it is completed, you can calculate, you can take the average, you can take a summation of all those abnormal return generated by the firm 1, firm 2, firm 3 up to firm 12, you can take. It means like the average abnormal return generated by the Canara Bank, generated by State Bank of India, generated by ICICI Bank, generated by HDFC Bank. Likewise, 12 banks, what is the abnormal rate of return is generated is being added, divided by M. M means number of firms in the event study, number of firms in the bank index. In this example is 12. So it is, you can identify or compute the average abnormal return generated during the specific period of time is calculated. And you can estimate the t statistics. While estimating a t statistics, it is required. So before estimation, you need to understand what is standard error. The standard error is calculated abnormal return, based on the abnormal return it is calculated. What is the standard deviation? Based on the standard deviation, based on the variance, it is estimated the standard error, and you can divide that, the it is average excess return divided by standard error. You can get the value of t statistics. If in case if your t statistics, the value of your t statistics, in case that the value of t statistics what you have calculated, it is, for example, 0.574, or maybe a 0, or maybe a negative. What interpretation you are going to make with respect to this event study? Let's say, for example, in this t statistics gives you the value like 0.547 or 0.9 positive value, infers that this information has significant impact, positive impact to determine the market price. So whatever the kind of similar kind of information which definitely is going to increase the market price. So it is basic assumption what we can have based on the market condition, whatever the value it is calculated. Second one, in case if becomes a 0, the t statistics is becomes a 0, not having any significant impact. Whatever the information you have taken, you have tested, does not have any significant impact to determine the market price. Maybe the kind of negative value you have received assumes that this particular information definitely is going to have a negative impact in the market. So likewise, the kind of interpretation you are going to take with respect to this conducting this t statistics for the event study. So hope you understand what is event study. The event study, first you need to understand what is the event is going to be studied. In this example I have given, you are going to study the annual returns or the profit announced by State Bank of India. It is about increased, the profit is increased compared to the previous financial year, increased about 70%. So it was announced, the information has reached to the market on 2nd May 2022. So you are collecting a return around the event date. It is decided to collect 21st April 2022 to 12th May 2022. It is going to be collected. Assumes that 10 plus minus 10 plus 0 plus 10. It means 21-day return is going to be collected. Minus 10 represented as the returns or the prices are going to be collected prior to the event. Plus 10 means after the event the returns are going to be collected. Similarly, we are going to calculate the excess return. The excess return calculated based on the risk-free rate prevailing in the market for the specific period of time, and you can subtract the beta or the return generated by the market, or what is the risk is associated with the market, the risk premium is going to be calculated, and you can find it out what is the excess return is required or expected rate of return is required from the market. Assumes that during the particular period there is about 5% is a risk-free rate it is prevailing in the market, and the market beta is 1.5, and the average rate of return generated by the market is 15. Then the 20% is a expected return from the market, is expected by the investor, and with that you need to calculate the return generated by the other stocks in the event study, other stocks in the particular market. How many number of firms? Let's say for example the study is conducted across banking industry, so the banking stocks, banking index is taken for the calculation. So with that, how many stocks are included, how many stocks are an index is available? With that, maybe 12 stocks or 12 companies are included on that index. We can take, you can calculate the abnormal return. It means what is the actual return generated during the specific period minus expected return for the each company in the event study. With that, you can calculate, with that you can take addition or summate all those returns generated, and you can calculate the average abnormal return. It means the return generated, the summation of return generated during the specific period of time, abnormal return generated during the specific period of time, divided by m. M here is number of firms in the event study. Finally, you need to calculate, you need to estimate the t statistics. For the t statistics, it is required to calculate the error. Standard error is going to be calculated. The standard error is the deviation of returns during the specific period of time with the number of firms in that event study it is calculated. So with that, you can identify the value of t statistics, abnormal return, average abnormal return divided by standard error. You can identify whether this event has a significant impact or not. In case the value you have received in positive, maybe 0.512 or 0.9, it is infers that this event has a significant impact to determine, significant and positive impact to determine the market price. So these event can be, with that, the kind of similar kind of event, the investor can be able to invest into the market, can generate the profit for over the period of time. Maybe it becomes a zero or closer to the zero, assumes that there is no significant impact with the information to determine the intensity in the market. The third important aspect, maybe it becomes as negative. Assumes that if it becomes as negative, where the event has significant impact, it means negatively adverse impact having in the market. So it is going to kind of an event reducing the prices over the period of time. So it is assumed or it is calculated based on that. The next one, empirical evidences on strong form of efficiency. So you know the weak form of efficiency is only the market information. Semi-strong form of efficiency, market information along with the publicly available information. Strong form of efficiency is based on the market related information, public information, private information. It means those information is specifically available for a group of investor. So those information, along with these information, we can have strong way in which you can determine the efficiency of the market. 100% the entire data is available. 100% the evidence is available. It can be provable. It can be easy to determine the market price. What we call it a strong form of efficiency. Wherein that the strong form of efficiency available on the public information as well as for the private information has a significant impact to determine the market price. So what are such information? We can call it a strong form of efficiency, can influence the strong form of efficiency, or those private information, what we call it as a private information. First one is corporate insiders. So the employees, the key employees who are working in the company is going to spread out some information, some key financial movement, the strategic movement of that particular company is going to be disclosed to their close relatives, that we call it as corporate insiders. But actually what those information is known by that particular employee alone, he is going to disseminate that information to their known circle. It is going to make that the circle of people, or that the people may aware that this company is going to take this particular decision, is going to buy that particular stock and generate the abnormal rate of return. But insider trading or corporate insider is actually prohibited under Securities Exchange Board of India. So this even not possible, but that kind of information that should have a strong impact to determine the market price. Second one, stock exchange specialists, brokers, it means the trading members and dealers who are giving a report, giving a suggestion to the investor. So the investor who are associated with that particular broking firm can get the information. That we call it as it means a strong form of efficiency, or it is a private information which may not be available at the free of cost to the other investors in the market. And the third one, security analysts or investment professionals who are giving the information based on the market. They are analyzing, they are evaluating. So the kind of a fact sheet, the kind of the circulation, the analyst report can be circulated to the investor, specific group of investor it may available. That is, we call it as private information. Unlike the professional money managers who publish the information. So who are reading that particular magazine, reading that particular, subscribing on that particular information can get the information. Okay. So that we call it as private information, though the private information has significant impact, high level of impact to determine the market price. So there are certain limitations which are associated with the efficient market hypothesis. So what are such limitations? The first one, the logical development of efficient market hypothesis gives certain assumptions for investment. It assumes that only the information has an intensity to determine the market price. Not only that, along with the information, the sentiments of investor, emotions of investors, that also play a vital role for determining the market price. But here it is only certain assumptions are taken for determining the investment. So that is one major limitation of efficient market hypothesis. Second one, empirical evidence regarding the randomness of stock price behavior seems to be overwhelming. So it is not only taken on this to understand the empirical evidence regarding the stock price behavior. Stock price behavior is not only the thing we can take as consideration for the calculation or consideration for the investment, because you know that the price movement or whatever the stock prices, the returns generated by the stock for the past, which may not be guaranteed for the future. So that the kind of limitation it is associated with the efficient market hypothesis. And the next one, many occasions the market reacts slowly. It is, we can't expect with the same time period the impact may happen. Let's say, for example, in the previous one I have taken, the State Bank of India has announced their final result, declared their profit, which was increased 70% compared to the previous year. With that, the information has reached the market on 2nd May 2022. With that, I have taken the event window of 21st April to 12th May I have taken. Maybe the intensity of information may happen after 12th May 2022. So it is not possible with that the specific period of time the intensity may happen. So that is also one of the limitation which associated with the efficient market hypothesis. It is mentioned as many occasions the market reacts slowly because number of other information, because we are not only estimating one information has significant impact to determine the market price at one particular point of time. There are number of other information. Cascading effect is going to happen in the market. With that, it is not able to measure. The efficient market hypothesis is not capable of measuring those cascading effect in the market. It is only measuring what is the impact of this particular event. Few events can be taken, but it is not possible for measuring that. Also, the limitation which are associated with the efficient market hypothesis. The next one, the market anomalies is not properly understandable. The movement of the market is not properly understandable. The movement of the market has significant impact to determine the stock price. But this information is not being aware because the market is random in nature. Market is not going to be a serial effect, going to give a serial effect. So in that particular aspect, the anomalies which is providing in the market, the sentiments which is providing in the market, the trend it is providing in the market, which you can't able to predict, you can't able to understand, you can't able to identify those anomalies in the market. So these are the some of the limitations which are associated with the market. You can say these limitations are associated with the efficient market hypothesis. The next one, implications of efficient market hypothesis. The first one, the substantial evidence in favor of randomness of stock price behavior suggested for the technical analysis. So this can be used as a technical analysis where can be used the substantial evidence, the sum of the evidence what it is being gathered, it is favor of randomness of the stock price behavior. And second one, routine and conventional fundamental analysis is not helpful in identifying the profitable course of action. So with that, we can't able to go for fundamental analysis. So what may be the problem with the fundamental analysis? It require a time period. A huge amount of time is required, need to spend by the investor for conducting the fundamental analysis, because the fundamental analysis is only for the investment for longer period of time where the investor holding that particular securities. But with that you need to conduct like the economic analysis, industry analysis and company analysis needs to be done. So it is not possible for the routine and conventional fundamental analysis cannot be helpful for identifying the profitable course of action. It is not possible across the firms in the market. These fundamental analysis may not be conducted. It consumes a lot of time. So previous one, substantial evidence which may not be helpful for technical analysis. Similar way, the fundamental analysis is too time process oriented process which cannot be repeated over the period of time. And early action on any new development, with that, we can use efficient market hypothesis. Can be easily tested, can be easily used as a parameter for understanding the market, parameter for understanding the movement of market can be tested. And access to the insider information and it can be sensible interpretation can be done, because it's not only the information pertaining to the market, information to the public, information to the private. If such information to the private which can make the more efficiency, which can definitely is going to determine the level of efficiency, 100% the predictability may be there. So these are the implication in which can use the efficient market hypothesis, rather the fundamental or maybe a technical can be used. For quick analysis can we go for efficient market hypothesis. Next one, random walk and search for theory. This random walk and search for theory, during 1953, Maurice Kendall examined the behavior of stock and commodity prices in search of regular cycle over the period of time. Let's say, for example, over the period of month, it is being conducted. Over the period of week, it is conducted to understand the price movement of stock with respect to the market. Different types of stocks, different types of commodity prices being conducted.
The important aspect you need to know about the random walk theory, or we call it a search for theory. What exactly in this particular theory? Randomness is an independent price movement. Simply, I can say. Random walk, it means what is the price movement of such stocks in the market. The market price cannot be predicted. You please understand that market price cannot be predicted. But anyhow, what may happen, whatever the independent movement of the price, over the period, we can found the pattern. Either it is in increasing trend, either it is in decreasing trend. We can't able to predict the price, but we can predict the kind of a movement of the particular stock in the market. This is identified from the even kind of the random walk study or random walk theory. So this particular theory, Maurice Kentel during the year 1953 has examined the stock and the commodity price in search of regular cycles. For example, every day they are find out the price of such a stock. It is available in the market. Every week it is find out the stock in the market. Every bi-monthly they are checking the price of such stock or commodity in the market, or monthly. With the periodical interval, they identified the price movement of such a stock or price movement of such commodity. Like they identified that what would be the movement, how the stock prices are traded in the market, what would be the point in which the stock prices may not be increased, or what would be the break point in which again there may be a kind of the resetting point for the particular stock. Again, if the stock prices are going to reach that level, again it is going to fall below the level, again it will be improved. So like the kind of search theory is identifying the kind of information about the movement of price, how the behavior is there in the market. During 2005 2007, I just had my own account for making trade in the market. At the time, I give much priority for purchasing of ITC. Why I gave much priority at that particular point of time? Whatever the value it may go. During the period, it was 157 rupees. There may be a changes in price. There may be a declining in price. But anyhow, I can take at one particular point of time, the stock may available on the price 157 rupees. If today it is like 162 rupee, I just frequently buy ITC as a rollover stock. It means the stock price may increase, again it may decrease into that particular point. So whenever the value it becomes low, I interested to buy the stock. Whenever the price it becomes below the 157 points, I frequently buy that particular ITC in the market. It is going to reach 160 or 162. I just sell the shares in the market, whatever the information is related to that. Because of the price movement alone, I am making investment on the particular stock ITC. Like there are a number of stocks at that particular point of time. Like Sipur paper mill, there is one paper industry, and Ambuja Cements. Like those companies, they have certain values or certain average values of such a stock in the market. For a period of time, it might be traded around the value. So the low value, you can take the average value, below the average, you can buy, above the average, you can sell. The similar formula have been adopted for the speculative purpose, or you can take it for the trading purpose. So this is like a search theory. This is like a search of information. How the stock prices, which are tend to change over the period of time. We just have to identify accordingly, can make how to react in the market. And during the year 1959, Harris Robert showed that the series obtained by cumulating the random numbers bore resemblance in the time series of the stock prices. They found that there may be a kind of changes in the price. It may be the random, or it may be independent. One day the stock price may be 150 rupees. Second day it may be 138. Third day it may be 146. Fourth day it may be 172. So there may be a different price. We can't able to predict that. But the Harry Robert has identified the kind of resemblance may happen over the period of time. The same level of 10 trading day, whatever the price, whatever the movement of price, it is closely related to the trading day which might happen in another 10 days. The kind of resemblance may happen. It is like the market has started one particular trading day, it is a positive. I just have to mention here. One trading day it may be a positive, another trading day it may be a positive, another trading day it is a negative, then positive, 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 and negative, negative. So this type of pattern is being identified by the Harry Robert. So what this cycle, if it has been repeated, we can say it is resemblance, whatever the price. If there may be a two positive changes, again one fell down in the market. Again, there may be three positive changes might happen, two fell down happens in the market. Like the kind of price behavior alone can be predicted. So what happened? You can take it comes around the 8 trading days. The same level of 8 trading day or 8 successful trading day may be repeated in future. It can be predicted. It has to be predicted by Harry Robert in his research. A random walk, it means the successive stock prices are independent. We are not going to say this is what the exact price the stock should be traded. No one is going for a kind of rules. So the stock prices which are independent, identically it was distributed over the period of time. Expected changes on the price can be positive because the investor expect to compensate the time and risk, because the investor wants to take the risk. Investor wants to wait a period of time for getting the benefit out of the particular stock for making an investment. So these things may be a favorable, bring a kind of favorable things to the investor. At one particular day, the kind of the profit or the kind of returns may be a low. Can wait for another day, the returns may be increased because the investor has to take a risk. The risk has compensated with properly with the returns, so that the basic assessment or assumption under the random walk theory. Information are freely instantly available for all the participants, so the market reaction is also the kind of the changes which might happen in the market according to the information which was available. Market reflects the intrinsic value, so this is important here. What understand, either a efficient market or a random walk you can take. It is found that the intrinsic value or the real value in which the stocks are available, or the real value have been identified, the stocks to be traded in the market. If the market prices reflects the intrinsic value, it means the market prices are in and around the intrinsic value. The market is efficient. It can be easy to predict the market conditions. Price changes are only response to the new information. It does not mean that the prices are not fluctuating until otherwise there is a information available in the market with respect to the specific stock. We can be able to take that, and the price can be behave like a random walk. It is independent in nature, but we can be able to go for a long run or a short run or a short swing. We can be able to predict the market, able to predict the market condition. So these are the information or related to the efficient market, different forms of efficiency, random walk theory, and such for the theory. The next important aspect what we need to go for, equity valuation. What exactly the equity valuation? So this particular unit specifically we are going to deals with the valuation of securities, valuation of shares, debentures, and bonds. So with that, first what we are going to start with the equity valuation. So how the equity shares are to be evaluated. So the equity analysis which normally employ or deploy two different kinds of analysis. We call it as fundamental analysis and technical analysis. So what exactly the fundamental analysis? It assesses the fair market value of equity shares by examining the assets, earning prospects, cash flows projection, and profit and dividend potential for the particular company have been taken. So the fundamental analysis include economic analysis, industrial analysis, and company analysis. Threefold analysis have been taken. For what purpose this threefold analysis is taken? For the purpose of arriving the kind of fair value of the market, fair value of the securities, fair value of the security prices in the market. We can be estimate that. So this estimation, what we call it as a fundamental analysis. So the fundamental analysis, thereby examining the assets, earning prospects, cash flow projections, and dividend Potentials are the major parameter are taken for understanding of intrinsic value of such securities in the market. We can be predict that. And like the second important aspect is a technical analysis is purely based on the market, purely based on the market related information, price related information, volume related information, turnover related information, changes in the capitalization rate of that particular company. Technical analysis rely on the price and volume related trends, other market indicators to identify the trading opportunities in the market. Like we can go for pivot point analysis. There are techniques of fundamental analysis or fundamental equity analysis. We are going for fundamental analysis. What are the things we need to take into consideration? There are three different set of analysis we are going to execute to understand how the market is behaving or how the market prices are tend to change or what is the value of such security in the market. It is being traded in the market. What would be the real value or what would be the fair value in which the stocks are to be traded in the market? Accordingly, we had a kind of valuation techniques. We call it as fundamental equity valuation techniques. It is balance sheet techniques, discounted cash flow technique, relative valuation techniques are three important. So the balance sheet valuation technique or taken the information from the balance sheet, information taken from the assets and liabilities of the company. Like for example of identifying the book value of shares. So at the time of origination, at the time when the company was established, the time the share has been issued or the original value have been decided on the basis of face value. After that, there should be a rate or there should be a price in which the investor is ready to buy and sell the security in the market. We can say the market price. We can say there may be a kind of intrinsic value or the real value driven by the fundamental factors. And there is a value, we call it as book value of the shares based on the earning capacity of the organization, based on the books of value or the valuation of such securities as per the books of accounts. We can have a book value. So how book values are established? Based on the net worth of the company. Paid up capital plus reserves and surplus of the company is divided by the number of outstanding equity shareholders. You can be able to identify the book value of shares. What would be the book value? It is guided, it is available in the market. We can be able to find out. Liquidation value is find out how quickly the assets are to be liquidated. What would be the liquidation value? If all such assets of the particular company is being sold in the market after the depreciation, after the realizing the value, we can be find out the liquidation value of the company. The company has started with 1,000 crores, 1,500 crores. If I'm going to sell all those assets of such companies in the market, it is going to be sell it in the market for 800 crores. The 800 crores is a liquidation value. Replacement cost, thereby going to replace with the existing machinery with the new one. We have after detecting the scrap value, after the market value of existing machinery, either one of the value, and what would be the value of new machinery based on that the replacement cost is identified. This is with respect to the balance sheet analysis, or we call it as balance sheet techniques. And like we have discounted cash flow, dividend discount models, free cash flow models are the two important aspects. Valuation of securities, valuation of equity shares based on the market price, based on the dividend declared by the company, what would be the value at the end of the period? Or what might be the growth happens to the company, what would be the value which might change in the market, tend to change in the market. We can be able to identify that. And relative valuation techniques are used to identify certain relationship between the market price, it means the external performance and the internal performance of the company. External performance or the market performance or the market information of such a stock in the market. The internal performance is about the profitability, is about the earnings, is about the net worth, is about the sales of the particular company has been taken for the calculation. We can have price earning ratio is a market price divided by earnings per share of the company. Market price for such a stock is being determined based on the buying and selling position in the market. Buyer and seller in the market can can determine the market price. And the earnings per share is calculated on the basis of the profitability. What would be the portion of earnings available for equity shareholder divided by the number of stocks? We can be able to get the EPS, earnings per share. So the market price divided by earnings per share, you can identify the price earning ratio. And price to book value ratio, we identify that the market price compared to the book value, compared to the book price of such shares in the market, we can identify that the relationship has been established. Either the market price is closely related to the book value. If it is closely related to the book value, say for example, the market price is 120 rupees, the book value is 100 rupees. It means it is overvalued in terms of 1.2 times, 0.2 times, or 20 percentage excess to the book value it is being traded in the market. We can be able to identify that. Based on that, we'll understand from the sales market price to the sales price, selling price of the stock in the market. The market price is 200 rupees. Selling price per unit is about 500 rupees. So it is about 0.6 is a price sales ratio. How much the value of sales, how much the price in which the product is available in the market. Similar way, it is compared to the market price of securities available in the market. Can be compared. Can be able to get, these are the things we call it as fundamental valuation techniques, especially for fundamental equity valuations. These are the balance sheet valuation compared to book value, liquidation value, and replacement value. Discount cash flow, we have single period calculation, we have growth model, everything together comes under the category of discounted cash flow techniques. So these are valuation models we'll see in the next class with the relevant examples will be worked out in the next.
So just I will start with that. To recap the information what we have completed in the last class, that starts with the equity valuation. So hope you know that what are the methodology to be adopted for valuation of securities. So we are primarily adopting two important methods or two important tools for the valuation of equity shares. So the thing is, the first one, it is the fundamental valuation and technical valuation. We call it as the fundamental analysis. The fundamental analysis where you are going to make a kind of investment for a longer period of time. As such, you are going to invest for the company for longer period of time. Say, for example, more than 5 years, more than 10 years. You want to make such kind of investment into the equities where you are going for fundamental analysis. So result of fundamental analysis is to establish the intrinsic value of the security. Whereas how we are conducting the fundamental analysis, the fundamental analysis is being carried out with a different process, the different method is to be adopted for the fundamental analysis. We call it as threefold analysis. There are the economic analysis, industrial analysis, and the company analysis were normally used to evaluate these securities. So what is the outcome? What we are going to establish? We are going to establishing the intrinsic value of the security. What exactly the intrinsic value of the security? The intrinsic values or the real value of security. Okay. So that is to be evaluated from the analysis. So we are doing the fundamental analysis. First stage, you are going to analyzing the economy. Key economic variables are taken into consideration. For example, of GDP rate, GNP, national income, like the kind of the credit policy was owned by the government, announced by the government over the period of time, inflation rate prevailing in the market, unemployment rate prevailing in the market, like a poverty rate. So these economic indicators are to be taken to understand the level of economic performance in the market or the economic performance of the country, like balance of payment. Together, the kind of economic variables are to be taken. The second important aspect, once we analyze the economic variables, we enter into the industrial analysis. So, what are the contribution of economy? Which sector has contributed more towards the economy? We can say like agricultural sector, industrial sector, and the services sector. So, what would be the major contribution? Which sort of sectors are contributed more towards the economy? We just identify the kind of things like the services sector and industrial sector contribution is somewhat high compared to the agricultural sector in the market, agricultural sector in the economy. We'll just find out the companies, we'll just find out the industries that comes under the category. Let's say in the previous class, I just give an example of banking industry, pharmaceutical industry, like few industries are to be selected. Understand that in that the current situation, these industries are contributing more revenue to the government, more growth to the government, which might happen purely because of these two industries. So we'll just take the industrial analysis to understand the level of growth of these industries in the market. In terms, we are analyzing the industrial life cycle. What is the current position of that particular industry in the industrial life cycle? We can take. And like we just understand that what is the RSI, relative strength index. We'll just compare with the overall economy. What would be the relative strength index? What would be the major contribution or the strength is going to be the part of that particular industry? The importance given by the government towards the particular industry. So industrial policies, industrial changes, government policy related to the industries, the kind of attention given by the government towards the industries, we'll select the industry. With that, the industry will find out what are the companies are performing. We call it as company analysis. So the company analysis will just find it out what would be the major contribution of companies for the growth of the industrial sector. If we take, for example, of if the banking sector is performing well in the market, we'll just understand that what are the major banks which contributed the growth of banking sector in India. We can take State Bank of India, ICICI Bank, HDFC Bank we are taking. So those contribution is more comparatively the other banks in industrial sector in that particular banking sector. So we take those companies and we are doing the company analysis. So what exactly the company analysis? That the part of company analysis, we are going to analyzing the fundamentals. We are going to analyzing the assets and liabilities, profitability of the company over the period of time. So we can say we are going to find out the liquidity position of the company. We are going to say the marketability of that particular company. We can say the profitability. We can say the solvency position of the company, turnover of the company. So there are parameters we are going to take. We are going to analyze the situation of the particular company relative to the market, compared to the market condition. So this analysis is being carried out. We call it as fundamental analysis. So the fundamental analysis, you all know that it's a threefold analysis. We call it as the economic analysis, industry analysis, and company analysis. Well, first to find out the economic analysis, it means what are the major happenings in the economy. It is in terms of growth of the economy, in terms of inflation prevailing in the market, in terms of unemployment prevailing in the market. We'll just find out the positive and negative aspects of the market. We'll just find out what would be the perception of investors to make investment into the market. Like we can say the example of the foreign institutional investors, the foreign direct investment, how it is happens in the market, what would be the flow of funds from foreign market. Everything as a factor for determining the economy. Once if it is we found that particular economy is feasible for making investment, we'll just to find it out the next stage we are moving on to find out the industries which are contributing more towards the economy. We'll just to find it out the industrial growth rate. We'll just to find out the industrial development over the period of time, the life cycle of the industry. So those parameters are going to be taken and find out the feasibility of the industries and find out what are the contributions, significant contribution done by the particular industry, out of which what are the companies are performing well, what are the companies are maximum contributing the growth of the particular industry. We'll just find it out. So once we are going for that, we have find out the economy is favorable. Second one, we found a few industries are doing well in the market. Few industries are performing well in the market. Say, for example, of pharmaceutical industry, you can take example of banking industry are performing well in the market. We'll just find it out what are the companies are contributing maximum or the companies are contributing the growth of that index or growth of that industry. We'll just find it out. So in that particular parameter, we'll just find it out the capitalization of that company, what would be the relevant growth of the company in the market. So in that parameter, we'll find out the companies or the major contributor towards the economy, towards the industry. So those companies we are going to make analysis. What sort of analysis you are going to make? The financial analysis, evaluating the performance of those companies in the market, relative position in the market. So what are the parameters we are going to evaluate? We'll just find out the liquidity position of the company. It means how the company can be able to manage their short-term obligations, how they are going to able to honor for their short-term obligations over the period of time. Like for example, of current ratio, asset ratio, we have like liquidity ratios, and like the solvency ratios or the solvency position of the company, how far the company can be able to fulfill their obligations, future obligations or the long-term obligations. Like for example, can be revealed from debt equity ratio, capital gearing ratio, return on investments. Like there are some parameters we are going to measure that the relative position of the company, or we can say the solvency position can be estimated. The turnover ratios we are, or turnover position of the company can be estimated by the sales of or the sales volume of the particular company in the market. Similar to this, the profitability, how the profitability over the period of time. It doesn't mean that one particular point of time what would be the profit is generated by the particular company. We just find it out what are the growth rate of the profit over the period of time. We'll just find it out the gross profit, we'll just find it out the net profit. After the appropriations, what would be the portion of fund is going to be distributed, or the profit is going to be distributed in the form of dividend, or the portion of profit is kept for the future purpose. We call it as a retention. So like the kind of parameter we are going to study about the dividend policy of the company, like the growth or the growth prospect of the company. So that everything that we are going to study on the particular company, about the key financial indicators, about the credit worthiness of the company, everything we are going to study on that. So these are the parameters we are going to carry out in the fundamental analysis. The ultimate aim of the fundamental analysis is to discover the real value of such stocks being traded in the market. So that the real value we call it as the intrinsic value. So here it is mentioned the fundamental analysis. It is an assess of fair market value of equity shares by examining the assets, earning prospects, cash flow projections, and the dividend potentials over the period. Right? It not only bother about the profit, not only bother about the turnover of the company. It is also bothering a kind of things, taking care of few information, examining the overall assets in the organization. What would be the value of such assets? The earning potential of the company over the period of time, and like the cash flow projections, it's like a budgeting, the kind of inflow and outflow we are estimating. We are find out the cash flow operations, fund from operations, everything that we are doing. And that way we understand what would be the projected inflows and outflow of fund to manage the operations of the organization. Okay. Like a dividend potentials, what would be the stable rate followed by the company, whether the company can be able to provide or the promise the same level of dividend for the future. So in that the previous example, you all aware of that. The ICICI has given a profit or the dividend of 200%. It has been declared. Means the 20 rupees that they have given as dividend. It means the value of such equity, the face value of such equity in the market is about 10 rupees. So you all know that the dividend is only calculated out of the face value. The dividend is declared out of the face value. The dividend is not declared out of the market value. The market prices entirely differ. The market price is available for ICICI Bank. It's around 756 rupees. The stock price is being traded in the market. But you can take still the
price, still the face value of such a stock in the market is 10 rupee. So normally the dividend is declared based out of the face value of such stocks in the market. So like we find out the dividend potential. So these are the things normally what we are doing in the fundamental analysis. Part of technical analysis, you know that the technical analysis is being done for the speculative motive. It means what exactly the investor is going to stay with the particular investment for a very short span of time, very short period of time. They wants to be stay with the particular investment. Say for example, few days to few weeks, they wants to be with that particular investment. They wants to sell the investment to gain the abnormal profit over the period of time or abnormal rate of return they want to generate from the market. For that, the particular purpose, they might adopt the technical analysis. So the technical analysis is purely based on the market information, whereas the fundamental analysis is based on some information. What are the information? Information related to the economy, information related to the industry, information related to the company. All the major source based on that will find out the intrinsic value. The investor adopt the strategy to make buying or selling decision in the market. But where the investor adopt the technical analysis is purely based on the market information. What is market information? It is about the market price, volume related data, trade quantities, it means the turnover of the particular company, changes in the capitalization rate. So you know that the market capitalization is calculated on the basis of current market price multiply outstanding number of equity shares. So there are some parameters are to be taken while they are going for technical analysis. Technical analysis is only for short term. You can gain abnormal profit, or you can take the highest amount of risk over the period of time. You can go for technical analysis. Technical analysis is purely a kind of charting techniques. Different types of charts are being used for the purpose of predicting the market. The technical analysis is purely about the psychological aspect of the market. The market sentiment is being evaluated. The investor sentiment is being evaluated by deploying the technical analysis. So there are a number of charts. You know that the kind of charts like the candle chart. You can take example of moving average. You can take example of trend analysis. Those major things we can apply in technical analysis, that we can be able to know that what would be the movement over the period of time. We can say the bullish trend or bearish trend to find out the market, to find out the market condition. When we can say the bullish trend prevailing in the market, there is an upward trend towards the market. Bearish trend is about the downward trend prevailing in the market. Accordingly, the investment decision is going to be taken by the investor. Like some techniques, they are using like resistance point and the support point. So they use the resistance and support point like a pivot point analysis have been used by the deployed by the investor to understand what would be the average price in which the stocks are traded in the market. Along with that, they find out some values in which when the market is going to touch on this particular point, the first point is going to be reached to the second point. Say for example, if the average market price is about 150 rupees, it is about the next point, next target point, they will be set at the level of 170 and 190. It feels that if the market price is increased from 150 to 170, then definitely it is going to reach 190. The kind of assumption, it is going to be formulated based on the prevailing market condition or based on the investor sentiment. The price movement is fixed, and accordingly the investor is going to make trade in the market. So this is a two different types of analysis is being deployed in the equity valuation. So in that, the first one is the techniques of fundamental equity valuation. So what are the methods we are applying? What are the methods we are deploying to know that? So prior to that, hope any clarification in part of fundamental analysis and the part of technical analysis. Hope you are clear with the concept of fundamental and technical analysis. Any clarification?
No, sir.
We move on to that. We have the fundamental analysis will have the equity valuations. There are different models we are going to apply. What you already have studied in the financial management, we call it as dividend growth model, single period return calculation, required rate of return calculation, are these things which we might apply in the concept of equity valuation. It is a fundamental equity valuation. Call it as fundamental equity valuation. Okay. So the techniques, what are the techniques being used for equity valuation? The first one, balance sheet techniques, discounted cash flow technique. Third one, relative valuation techniques. So in that, the first one, balance sheet techniques. So what are the balance sheet techniques? Using some traditional methods, using some traditional financial tools. To apply that, we are going to identify the level or the relative position of the particular company in the market. We can say the book value is the first measure. Here it is given. So what exactly the book value? Book value is the current value of that particular company in the market. We can say what would be the wealth is accumulated for the particular company over the period of time. How the wealth is going to be accumulated for the company. Let's say, for example, the company has started, and I'll just use this Excel sheet. Just have taken like 1 lakh, the paid up capital of the company. You know that the company has started in 2005. You can take 2015 for 6 years. Will go for that. So it is a paid up capital. So the first year out of the operations are what we may have during 2016. The company earned a kind of a profit. It is about, the company has earned about 70,000 rupees as a profit. So if it is out of this 70,000 rupees, the company has decided, apart from all the expenses, I can say the 70,000 rupees, it means the portion of profit which is available for equity shareholders. It means after deducting the preferential dividend, after the payment of interest, after the payment of tax. So if apart from the everything, whatever the portion of earnings is available for equity shareholders, you can consider the company has started in the year 2015. During the 2016, the company has earned the 70,000 rupees as a profit. The profit means the portion of earnings available for equity shareholders. The company can have two different options to distribute the profit in the form of dividend, and the portion of profit is again going to be kept for the future purpose. So you assume that the 30,000 rupees is going to be given to equity shareholders. It means remaining 40,000 will be kept for the future purpose. So where they are going to keep this 40,000 rupees? So during the appropriation, this particular fund, this particular retention of 40,000 rupees, what we call it as, this particular portion is called it as retention. Retention. And what happens to this 30,000 is going to be declared in the form of dividend. So how many number of equity shareholders for this particular company? You assume that at the time of, since the issuance of capital, the company has decided its face value of rupees 10, and the company has issued 10,000 shares during the inception. At the time of inception, the company has issued. So you know that the situation, the paid up capital of the company is 1 lakh. The face value of such equity share, it is at the time of issuance, it was 10 rupees, and there are about 10,000 equity shares are issued by the company. The company has started during the year 2015. During 2016, the company has earned the profit of 70,000 rupees. So this 70,000 rupees, what I can say, the portion of earnings available for equity shareholders. It means after deducting all the expenses, including depreciation, including interest, including tax, including after deducting of the preference dividend, also whatever the portion of the earnings available for equity shareholder, it is 70,000 rupees, the portion of earnings available for equity shareholder. So what the next process, the company is going for the appropriation, the company is going to distribute the dividend out of this 70,000. So the company has decided to give 30,000 rupees as the dividend. So hope you know that what would be the dividend is going to be distributed per share. What would be the dividend is going to be distributed per share. Still, you can say the face value of that share or face value of the share, equity share in the market is 10 rupees. You can take the current market price during the 2016. The current market price is 23 rupees. Current market price is 23 rupees. So hope you know the dividend is declared only based on the face value, not based on the market price. So the 20 rupee is a 23 rupee is a market price will not be considered. Only the face value is considered. The company has distributed 30,000 rupees dividend out of 10,000 shares. It means a share is going to be get, a single share is going to be get the dividend of 3 rupees. If it is, it means 30% of face value is declared as a dividend. 30% of face value is declared as a dividend by the company. I hope you understand that the 10 rupee is a face value. Out of the 3 rupee is declared as a dividend. It means the 30% of the face value is declared as a dividend. Normally, you know that the dividend is calculated out of the face value alone. And the retention, what is a portion of fund is being retained by the company? We can say the retention per share. Here, the dividend per share, hence the DPS is 3 rupees. Hence, you can take the retention per share. So there are 10,000 shares per share, 4 rupees is retained. It means the 4 rupees is a retention per share. Retention per share. So this is calculated during the year 2016. So you need to understand what is the book value of such equity during 2016. So during 2015, the value of company is 1 lakh rupee. What is the net worth of the company? The net worth of the company is also 1 lakh rupee, because the company may not have any reserves and surplus at the time of origination. So what I can say, it is the net worth I can calculate. Here the net worth is 1 lakh during the period 2015. 2016, the company has earned the profit. Out of the profit, the 40,000 rupees is retained for the future purpose. So the 40,000 rupees is going to be added with the reserves and surplus of the company. So the net worth is calculated. The net worth is calculated on the basis of paid up capital plus reserves and surplus. So during the year 2016, the net worth of the company is paid up capital plus reserves and surplus. Here the paid up capital is 1 lakh plus reserves and surplus is 40,000. 1 lakh 40,000 is a net worth of the company. 1 lakh 40,000 is a net worth of the company. So during the year 2015, the net worth is 1 lakh rupee. During the year 2016, the net worth is 1 lakh 40,000 rupees. You can say, you can take, for example, during the year 2017, you just calculate for the during the year 2017, the company has earned the profit of 1 lakh rupee. Out of 1 lakh, 40,000 is going to be distributed in the form of dividend, and 60,000 is going to be retained for the future purpose. Hope you know that the dividend per share is 4 rupee. Retention per share is 6 rupee out of this calculation. So this retention is again going to be transferred to the reserves and surplus, going to be added to the capital. So what the exact net worth of the company during the period 2017? Before that, you understand the current market price. You can take 33 rupees is the current market price during the period 2017. So during the year 2017, the net worth of the company, the paid up capital plus reserves and surplus. So it is the paid up capital. Here it is 1 lakh plus reserves and surplus account. Already in the reserves and surplus account, we have a 40,000 rupees. Together here, the 60,000 rupees is going to be transferred to the reserves and surplus. So it means, again, it means you can take here the 40,000 rupees is already there in the reserves and surplus. Here again the 60,000 rupees is going to be added. Together the net worth of the company is 2 lakhs. Together the net worth of the company is 2 lakhs. So the company has started with the paid up capital of 1 lakh rupee during the period 2015. During 2016, with the profit, accumulated profit, it is the net worth is going to increase to 1 lakh 40,000 rupees. During the year 2017, the
accumulated profit, the reserves and surplus, together it is going to increase to 2 lakh rupees. Okay. Hope you understand how the net worth is calculated and what is the role of paid up capital. Second important aspect, you know about the face value of the company. So that constant over the period of time, and all the dividend, whatever the decision is going to be taken by the company towards the declaration of dividend is purely based on the face value of the company. Only it is declared. So you know that during the year 2016, 30% of the dividend is declared by the company. It means the 30% of face value is declared as a dividend by the company. During the 2017, you can take 40%. You can take the 4 rupees is declared out of 10 rupees. It means 40% of the face value is declared as a dividend. And net worth, it is noted that during the year 2015, it is 1 lakh. During the year 2016, it is 1 lakh 40,000. During the year 2017, the net worth of the company is 2 lakh rupees. So how the net worth is calculated? The net worth is calculated paid up capital plus the reserves and surplus of the company. So next one, here it is given for the calculation of paid up book value. So how the book value is calculated? So here book value is calculated on the basis of net worth of the company divided by number of equity shares, number of outstanding equity shares of the company. So on the basis what we can take, we'll calculate the book value of shares. So the book value of shares is calculated. You can take during the year 2015, the net worth of the company is 1 lakh rupee divided by number of shares issued by the company. Number of outstanding equity shares available with the company is 10,000 rupees. Hence, the book value per share is 10 rupees during the period 2015. And you can take during the year 2016, 1 lakh 40,000 is the net worth of the company and 10,000 is a number of equity shares in the company. The 14 rupees is a book value per share during the period 2016. Similar way, you can take the net worth of the company during the period 2017 is 2 lakh rupees divided by number of outstanding equity shares is 10,000 rupees. So 20 rupees. So you know that here the market price, the current market price or the market price during the period 2016 is 23 rupees. Here you can take the market price during the year 2017, it is 33 rupees. So it is purely based on the market condition. The market price is purely based on the market condition in which the price the investor ready to buy and sell the securities in the market. On the basis the market price is determined. Hope you understand. But how the book value is calculated? The book value is calculated on the basis of net worth of the company divided by number of outstanding equity shares in the market. So based on the calculation, so how many number of equity shares issued by the company? The company has already issued 10,000 shares in the market. So the 10,000 shares are issued by the company. The total net worth of the company during the year when the company has started at the period, 1 lakh is a net worth of the company. It means 10 rupee is a book value per share. The similar to this 2016, the book value per share is 14 rupee. During the year 2017, book value per share is 20 rupees. We can take as per the calculation. Okay, so this is, we call it as book value per share. So when the company is going for, after the period 2017, you can take if the company is going for a kind of expansion or going for a kind of diversification. So what the company is going to make the changes, how the company is going to make changes in its capital structure. So they have an option to use their reserves and surplus for the purpose of meeting out their requirements, for the purpose of expansion plan to the organization. So it is a cheapest way in which the funds are available internally to the organization. One thing. Second one, in further, the requirement is there for the organization. The organization may issue a kind of capital, collect the capital from the market. If it is a public limited company, if it is a listed company into the stock exchange, they can be able to raise the capital from the market. Hope you all know that there are different methods in which the flotation of securities are happen. You can be able to mobilize the capital for your company, either in the form of initial public offering or further public offering or a right issue or preferential allotment or a private placement. There are different methods to be adopted by the company. According to the nature, they will be collecting the capital from the market. Either they may be selecting a kind of public offering or institutional placements. Either it may be in the form of private placement or preferential allotment to be adopted by the company for mobilizing the required capital from the market. So accordingly, why I'm saying that, accordingly, there may be a kind of changes happens in the company. Accordingly, the changes happens in terms of the net worth of the company. Accordingly, the changes that happens in the market price. Accordingly, the changes happens in the book value of the shares. So whenever there is increase or the changes happens in the net worth, is also affecting the book value of the shares in the market. Okay, so this is regarding the book value of securities in the market. So you know that this particular purpose, the paid-up capital has been issued for the purpose of procuring the required assets to the organization. So you all know that the fixed capital which is required to establish the enterprise, for that the particular purpose we are using. So that is what, whenever you have the total liabilities, it means liabilities plus capital together is equal to the value of asset. It means whatever the fund we have procured for the purpose of establishing the organization, equal value of assets we have got. Equal value of cash we may maintain with the bank. Equal amount of investments available in the market. So this is the basic thing that we have according to the balance sheet. The total capital plus liabilities which are equal to the value of assets in the market. So this is going to be identified. So it is only about the book value. It is only about the book value of asset. It is only about the book value of liabilities. What is the liquidation value? Liquidation value, it means if you are going to convert all your assets into a cash, what may be a cash you are going to get? Say for example, this 1 lakh rupee is going to be used for purchasing of assets. So if you are going to sell all the assets of your company, what would be the value you can be realized from the market? So that the value realized from the market, we call it as liquidation value. So here you can take, I have given the liquidation value, the value realizing from liquidating of all assets of the firm minus amount to be paid to the creditors and preference shareholders divided by number of outstanding equity shares. So exactly what we are going to find it out, the amount of liability, what it is rest with that value, or after liquidating, what would be the portion of fund is available for the equity shareholders. It can be identified from the liquidation value. Say for example, in the liquidation value, you can take liquidation of all the assets. So normally you know that the capital plus liabilities together you can have the asset. So here the capital is 1 lakh rupee, plus if the company may have a liabilities of 2 lakh rupee, it means the total value of asset is equal to 3 lakh rupee in the market. So if I am going to liquidate all the 3 lakh rupee or all the 3 lakh rupee worth of assets in the market, let's say for example, if I'm going to sell all the assets of the company, if it is 2,25,000 rupees, I can be realized. So this is called realized value of asset. Realized value of assets. Realized value of all the assets in the organization. And I'm just going to subtracting the value of creditors, subtracting the value of preference shareholders. It means whatever the portion I have issued in the form of debentures, I'm going to issue in the form of preference capital. I just wanted to know what would be the portion of fund is available for equity shareholders. What would be the portion of fund is available for equity shareholders. So you can take, this is a realized value of assets and liabilities. For the debtor, I'm going to pay for the debentures. For the debentures, or we can say is a creditors for the debentures, I'm going to pay 50,000 rupees. And like you can take the example of preference shareholders or also the outside of the company and going to pay 20,000 rupees. So together this, the outsiders fund, we call it as insiders fund and outsider fund. Which fund is considered as an insider fund or owner's contribution? Equity shareholders are the real owners of the company. So whatever the contribution done by the equity shareholders, consider as fund being contributed by the other sundry creditors who had contributed the capital to the company, who had contributed the money to the company. So together, after deducting that, if we can say outstanding amount is 70,000 rupees. So you can take this realized value of all the assets minus the debentures and the preference shareholders. The value is or value realized by the equity shareholders of the company is 1,55,000 rupees. And this value is divided by the number of outstanding equity shares or the outstanding equity shares in the company. There is about 10,000 equity shares are available in the company. So the liquidation value per share of the company is 15.5. It is 15 rupees 50 paise is what the liquidation value. So you can once again find it out. If you need any clarification on this, just write the question. So hope you know that the book value is calculated. So how the book value is calculated based on the balance sheet. First one. The second one, what we can find it out, the liquidation value. The liquidation value is conversion of all your assets into the cash. Assets into the cash. After meeting out the expenses or after the payment to the creditors, after the payment to the other the external people. It is like we can have the preference shareholders. After meeting out, what would be the portion is available for equity shareholders. So in this particular example, the capital is about 1 lakh rupee, and the company might have the other the creditors, other borrowings in the form of preference capital and other borrowings. They may have 2 lakh rupee. So the 3 lakh rupee in the form of liabilities, the same 3 lakh rupee is reflected in the form of asset. It means those assets are going to be liquidated, going to be sell it in the market. You might realize the value. The realization of value is given here after deducting the depreciation or the market value of such assets in the market. It is 2,25,000 rupees is given here. So out of which it is calculated like a debentures issued by the company is 50,000 rupees, and the preference shares to the preference capital they have collected 20,000 rupees from the market. Together this value of creditors comes together 70,000 rupees for the company. So if I am going to realizing the value or what the value is available, the residual value is available for equity shareholder. The residual value of, we can say it as liquidation value or residual value. The residual value of 1,55,000 rupees is available. So there are about 10,000 shares issued by the company. So per share 15 rupees 50 paise is available as a liquidation value. So it is find it out from the liquidation value. So this is the second part. Third part, we are going to find out, third important tool we are going to use, the replacement cost. Replacement cost is going to be used, the cost which is required for replacement of assets, replacement of existing machinery. If that the machinery is not in use, or we are going for upgradation of technology, for that the particular purpose, we are going to replace the existing machinery. So what would be the cost? It means after deducting the scrap value, or else the particular machinery might have a market value. Either a scrap value or a market value for the existing machinery can be subtracted from the purchasing of new machinery. We can be able to get exactly the replacement cost. Here it is given the replacement cost of all its assets minus liabilities. The market price of replacement cost is can be calculated. We call it as a technique. We call it as WQ is a technique can be used for this particular purpose. Simply you understand the replacement cost of all its assets. If I have assets, 3 lakh rupees asset value I have in my organization. The liquid value, liquidation value, if I'm going to sell all those assets, I might realize 2,25,000 rupees. If In spite of that, if I'm going to replace all such assets, I'm going to replace all such assets. It might require 3.5 lakhs or 4 lakhs is needed. You can say example of 3.5 lakhs is needed. And what is the total liabilities? The liabilities is about 3 lakhs I may have. So the remaining 50,000 is what the replacement cost. You need to spend that particular cost for replacement of asset. You can be spend that for the replacement of asset. So here you understand the total assets and liabilities are associated with the organization. If you are going to sell all those assets in the market value can be realized after the depreciation. It can be realized about 2,23,000 rupees. It's the same thing. In spite of you are going to selling the asset, if you are going to replacing the asset, replacement of this 3 lakh rupee, if it is 3,50,000 rupees needed for replacement of all assets in your organization. Replacement of all assets in your organization. It means this 3,50,000 rupee minus the total liabilities of the organization. The total liabilities, it comes 3 lakh rupee. So the remaining value of 50,000 rupee, the remaining value of 50,000 rupee, what we can say, we can take it as the 50,000 rupee as the replacement cost. It means the 50,000 rupee is needed for the purpose of replacing all. So this is what given in this particular formula, replacement cost of all assets minus liabilities. The market price of replacement cost is calculated. Market value of or the market price of replacement cost is calculated. Okay. So this is the three important balance sheet valuations. So from this example, hope you know that three different methods what have been used for the purpose of understanding replacement cost or the replacement value. We have book value, we have liquidation value. So the next one, what we have discounted cash flow. So hope it is clear. It is just we are going to use like ratios for the calculation. The second one is what the discounted cash flow or the discounted cash flow techniques are giving importance for the time value of money what you for that the particular purpose you are using, you are applying a method, we call it as discounted cash flow. Simply I can say if I'm going to receive 100 rupee in the next year, the value of 100 rupee in the next year is not equal to the value of 100 rupee on today. So that we call it as discounted value or the concept of discount value is going to be applied. Say for example, you all know that how the discount value is calculated. Say for example, what is the rate of return is expected by the investor. Accordingly, the discount rate is calculated. What is the rate of return is expected by the investor? It means the rate which is required by the investor to make investment into the market according to the prevailing risk in the market. So the risk is going to be compensated with the returns, expected returns. We can say expected returns going to be the factor going to be compensated with the risk taken by the investor in the market. This is normally is going to be compared with the risk-free rate. Hope you know what is risk-free rate. Risk-free rate, it means the rate in which the government securities are being traded in the market. For example, of 364 days treasury bills. For short term, we can take, or like a government securities with the tenure of 15 years to 20 years, in which the coupon rate is applicable for such government securities. We can take it as risk-free rate. It means those government securities are free from the risk. What sort of risk they are free? It is the free from default risk, free from interest rate risk over the period of time. It means whatever the consequences may happen, if the government may not be able to repay such amount, the government has the power to print the currency notes and they can be able to repay such amount. So that can be possible. Then we can't able to realize a kind of default risk when once we are going to make investment into such kind of government securities. So whatever the interest is being given by such government securities are taken as a risk-free rate. So the risk-free rate is technically called as zero beta. So in that particular level, the zero level risk, what would be the return can be generated without taking any risk? What would be the return can be generated? And what is the amount of risk taken by the investor in the market? Accordingly, the expected rate of return is calculated. So we have a formula according to Iapm, capital asset pricing model. We have calculated the required rate of return. What is the required rate of return? The formula we can use R of minus. It is calculated risk-free rate plus beta of the return generated by the market minus risk-free rate. So the return generated by the market minus risk-free rate, we can get the risk premium. So the risk premium is going to be multiplied with the beta. I can be able to get risk-adjusted return expected by the investor. Along with the risk-free rate, I can be able to estimate the required rate of return by the investor from the market. Okay. So accordingly, calculate the required rate of return. So here the required rate of return, here it is mentioned as R. So particular calculation, what the principle is applied, the discounting principle is applied. Say for example, if I am an investor, I can expect 10% of return from the market. So there is about the 100 rupees I will be receiving in future. So what would be the present value of such 100 rupee on today? I'll be applying a discounting principle. It means 1 divided by 1 plus r to the power n. What is here is R? R is the required rate of return. What is the rate of return expected by the investor? I can expect 10% of return. It means 1 divided by 1 plus 10 divided by 100. It means 1 divided by 1 plus 0.10. Why it is 0.10? 10 divided by 100 is equal to 0.10. It means 1 divided by 1.1 to the power 1. It means 1.1 divided by 1. You can get the factor value or discount factor value 0.909. So what exactly the 100 rupee what I'm going to receive in next year is equal to the value of 90 rupees 90 paise on today. So that I can be able to predict by applying the concept of discounting, applying a principle of discounting. The similar way, the discounting principle is applied with respect to the cash flow of the company over the period of time. So there are few parameters are to be taken for establishing the market price of such securities in the market. Say for example, there are few parameters only used here for the calculation of discounted cash flow. One is here it is mentioned as P0. What exactly the P0? Market price of security at the beginning. And we can have the P1 is market price of the security at the end of period. And D here is denoted as a dividend. D1 is a dividend you will realize at the end of the period. I can say the next year what would be the dividend you will receive. The dividend is called as D1. And here it is R. R is represented as a rate of return. What is the required rate of return is expected by the investor for making such investment into the market? We can say it as R. And the G here it is represented as the growth rate. What is the expected growth rate? So some model or some techniques we might apply a simple technique for the single cash flow or single period calculation. Single period calculation, we might apply the kind of the concept. Simply, I can say the first. I can take the first one for calculating the present cash flow or the market price of security at the beginning is calculated is equal to the D1 dividend received in the next year divided by 1 plus R to the power n. It means whatever the year this dividend is received. If the dividend is received at the end of the 1 year, it means to the power 1. If it is a D2 dividend received at the second year, we can take D2 divided by 1 plus R to the power 2. So similar way what we are going to take, in which period we are going to realizing the value, accordingly we'll calculate the discount factor of the second one. It will be calculated on the P1, market price of the security at the end of the period. So it is also going to be calculated in prior 1 divided by 1 plus r to the power n. So if it is, we are going to calculate for the first period, for the first year, it should be a value of 1. N is equal to 1. N is a number of terms, the number of years in which we are going to do the calculation. So simply I can say the price, market price is going to be calculated based on the future price or the end period price plus the dividend given by such securities is going to be converted for the present value. It's going to be converted for the present value. I can be able to find out the market price of such securities at the end of the period. At the end of the period. Or alternatively, I can say, it is, I have, say for example, I just given here P0, the market price at the beginning, it is 100 rupees. The dividend declared by the company. So prior to that, what I can say, I can expect the required rate of return from the investment is 10%. Required rate of return from the investment is 10%. So what is P1? Simply I can say what is P1. P0 is a market price at the beginning of the security, So 10% is the expected rate of return. So simply I can use the compounding principle here. Why? Because I'm asking that, I'm not asking P0. P0 is a present value. Whereas I'm just asking the future value. It is mentioned as P1. So simply what you are doing, P0 multiplied 1 plus r to the power n. 1 plus r to the power n. So here the r is 10%. It means 1 plus 10%. It means 1 plus 0.10 to the power 1 for the 1 year we are going for the calculation. So 1 plus 1, 0.1, 1.1. So you just multiply this. 100 multiplied 1.1 is 110. Is 110. What is exactly the 110? 110 is a P1. 110 is a P1. You just apply. So similarly, what you can take in spite of taking the P0, in spite of taking a P1 value is given as 110 rupees. If P0 is requested from the particular problem, hence how you are going to calculate the P0 is equal to P1 divided by 1 plus r to the power n. Here the P1, here the P1 is given as 110 rupees. So the previous problem you just have noted what is the value. So I'll just calculate the P1 is 110 divided by 1 plus r to the power n. So 1 plus 10 divided by 100 to the power 1, it means 1 plus 0.1 to the power 1. It means 1.1 to the power 1. Simply what you can do, divided by 1.1. You can get the 100 rupees. 100 rupees as a beginning of the price. Simply what we are applying the same type of formula for the calculation. Okay. So once we are going into the dividend discount models, okay, please understand that whatever the market price at the end of the period and the dividend received during the period is converted to the beginning period. We'll be calculating that what would be the price in which the shares are available at the beginning of the period. We can be able to calculate from